Welcome to the introduction to money. Here's the table of contents. We're going to be talking about what money is, the history of money, fiat currency, and we'll do a recap at the end. Let's get started. First off, I want to talk about lifespan and question our relationship with money. According to Bureau of Labor Statistics, on average, employed persons spent around 7.6 hours on the days they worked. That's nearly 50% of our day when we subtract 8 hours of sleep that few of us get. If we look at the time breakdown of a long human life on the left, a typical career takes up around 20% to 60% of our meaningful adult time. I want to emphasize the importance of financial freedom as it gives us more opportunity and find meaningful work aside from financial incentives. In a report from Pew Research, about 6 in 10 of those with an annual family income of $75,000 or more say that they're very satisfied with their current job, compared to 39% of those making less than $30,000. Financial stress can be reflected among this chart, and we need to make sure we have control over our money. If you don't gain control over your money, it will control you. Money in circulation. Before we dive into the basics, I'd like to share how much money is in circulation to keep in mind throughout the presentation. As of December 31st, 2020, the Federal Reserve, which is the Bank of the US, reported around $2 trillion in circulation just inside the US alone. According to BIS, which is the Bank for International Settlements, there's around $7 trillion in circulation around the world. This is physical money that's available in currency and coins, and money in the form of investment, derivative, and cryptocurrencies exceed $1 quadrillion. Yeah, I didn't even know quadrillion was a number. The derivative market includes assets such as equities, commodities, bonds, and currency. When I heard all these numbers, it went past me as I could barely even count to 1,000. So let's visualize this number. So on the top left, we see $100, and the size increases as we move to the bottom. I want to make sure that you guys know that 1 million has 6 zeros, 1 billion is 1,000 million, 1 trillion is 1,000 billion, and 1 quadrillion is 1,000 trillions. That's 15 zeros. Can you guys spot the little human standing next to the quadrillion? It's a huge number. The use cases of paper money have grown into an enormous supply over the past century, accounting that US dollars was only created in 1792. So, let's discuss the definition of money. What is money? Money can be defined by 4 primary uses over the course of history. Means of exchanging goods and services, payment of debts, general measure of value, and stored as a wealth reserve. Money is a technology tool which allows people to trade goods and services indirectly. For example, you can make a deal with a guy named Elon Musk without knowing him. As long as your money and his products are good, you can do business. Money allows people to trade goods and services indirectly, pay back debts, communicate the price of goods, and provides individuals a way to store wealth in the long term. These characteristics encourage trade and division of labor, making economies more efficient and productive. The functions of money. There are 3 main functions of money, which are store of value, medium of exchange, and unit of account. Let's take a deeper look into each function, and I'll give some examples as well. So, store of value means that you can save it and use it later. Some examples include commodities such as gold, silver, and Bitcoin. Gold is reliably saved, stored, and can be retrieved. Medium of exchange is an intermediary people can use to buy and sell from one another. For example, if I wanted a golden toilet and the seller wants cash, I need to sell some lemonade to convert to cash, which is accepted as a form of payment. Cash is treated as a medium of exchange here. Another example includes compensation for work. For providing a service, you are compensated with money. People used to use shells, tobacco, and stones as a medium of exchange back in history, which we'll take a look at in just a little bit. And unit of account. Unit of account just means that the monetary unit provides a common base for prices. Think of it as a yardstick that allows people to compare the values of goods and services in relation to one another. For example, real estate prices in US can be compared using US dollars. Now, onto the characteristics. So there are 6 characteristics of money that I want to talk about: durable, portable, divisible, fungible, acceptable, and stable. And we're going to be using cow as well as the US dollars in comparison. So durable. It must be able to withstand the wear and tear of being passed from one person to another. US bills last 18 months, whereas coins last up to 30 years. But compared to a cow's average lifespan is only 2 to 4 years. Portable means that it's easy to carry. Cows aren't too portable compared to a bill, because you could put a $20 bill inside your pocket. Can you fit a cow inside your pocket? I mean, not likely. Divisible. Money should be easily divisible into smaller parts so that purchases of any price can be made. Carrying coins and small bills make it possible to make purchases of any count. Cows can't be broken down to parts as easily compared to a bill during an exchange. Fungible. Fungible means that the unit is equivalent to another unit of the same goods. For example, I can trade $1 with you for the same dollar you have. I can trade my $1 bill for your $1 bill. Cows aren't perfectly fungible as they have different weight and characteristics. Accepted. People all around the world perceive gold as a universal store of value. US dollars is commonly accepted in stores, whereas merchants might not accept a cow as a payment option. I can't just bring a cow into Subway and, they're going to accept it as a form of payment. Stable. Value cannot change rapidly, or its usefulness as a store of value will decrease. So scarcity kind of gives it its value. The Federal Reserve uses monetary and fiscal policies, such as shrinking the money supply during an inflation. The price of a cow depends on the cost of raising one. So expenses such as hay, breeding, and food affects the price, so it's not as stable as a dollar. Now, onto the forms of money. There are 3 primary forms of money, which is commodity money, fiat money, and fiduciary money. Commodity money are items that derive intrinsic value from which it is made. Few examples of commodity money are gold, shells, and silver coins. These items derive value from commodities itself and hold underlying value. So let's give an example. So gold is used for money, but it's also used in manufacturing of jewelry. Fiat money is money that is given value only by the order of the government and trust of the people. Value is not derived from any inherent characteristic. I mean, maybe you could use it to wipe your butt, but it's not as valuable compared to manufacturing as a jewelry piece. For example, the US dollar or euro holds value because others know that it can be used as a form of payment. Fiduciary money is essentially debt created through the fractional reserve system. Examples of fiduciary money includes demand deposits, credit cards, and debit cards. Fiduciary money is worthless in itself, and its value comes from being able to exchange it for something else. Similar to fiat money, its value depends on the confidence that it will be accepted as a medium of exchange. History of money. Money has more than one origin story. There's a debate between anthropologists and economists where the first currency was created 5,000 or 8,000 years ago. We're going to observe the recorded ones, which have shaped our current monetary system. According to anthropologist David Graeber, money was first used to define the structure of social relations. Some use cases include arranging marriages, establishing paternity of children, seeking forgiveness in crimes, negotiating treaties, and acquiring followers. As use cases kind of grew over time, we began to see more innovation in money. This innovation took time and rose from problems. Let's take a look at the problem with the barter system. Sophisticated money emerged from problems like double coincidence of wants. The double coincidence of wants requires that the needs of a seller of a commodity must match the needs of the buyer for a transaction to occur. Let's say you have a bunch of bananas and you want a golden bidet. It's not enough to find someone who has a golden bidet. To make the trade, you need to find someone who's willing to trade their golden bidet and want bananas. All right, now we're going to take a look into the innovation of money over the course of history and how they solved The issue of the double coincidence of want is through common currency, because it represented money's usability when dealing with people you don't know and may never see again. The Kingdom of Lydia, which is modern-day Hungary, established the world's first standardized coins. The standardized metal coin was made of gold and silver alloy called electrum. As we discussed the functions of money earlier, this coin served as a good store of value as it didn't age or die like a cow. And the Lydian government started to stamp their signatures on the minted coins, which established the authority of the state and facilitated the flow of trade. In addition, other kingdoms were quick to embrace currency early on as it facilitated the collecting of taxes and building of military forces. More than 1,000 years later, in the 7th century, paper currency was first introduced in China. These are promissory notes known as jiaozi, my apologies for the pronunciation, printed by a group of merchants during the Song dynasty. These notes were exchangeable for coin-based money and replaced by another note called the huizi. The European banknotes in 17th century. The paper money we use today was invented in the 17th century, and the first Europeans to use banknotes were the Swedes, who developed paper money to substitute copper plate money, which weighed up to 50 pounds. Imagine how revolutionary that must have been. And next, we have US issuing paper and coin currency in the 18th and 19th century. The Continental Congress issued paper currency in 1775 to fund the American Revolutionary War. The Coinage Act of 1792 introduced the American coins into circulation to meet the demands of a growing nation. And in 1861, US issued greenback, which was created by the Union government to help finance the Civil War. Greenbacks financed about 15% of entire war efforts, but accounted for 14% of the inflation during the time. I know I just spit out a bunch of numbers and that might not make sense, but the key point here is that money in the US was primarily used to finance wars. And also during this time, the government began to issue certificates in exchange for deposits of gold, which were a lot easier for people to carry. Now, the present day, in the 21st century, the majority of money we currently use is fiat money. Fiat money is backed entirely by the full faith and trust in government, not by any reserves. With the increase in technology, we also use debit and credit cards to no longer carry around physical cash. And I also want to talk about the future, which is digital cash. Digital money, it is money in purely digital form. It's not a tangible asset like cash or commodities. Digital money like Bitcoin can be a catalyst for change to make cheaper and faster monetary transactions and ease the monetary policy implemented by central banks. Cryptocurrency was created in the wake of 2008 global financial crisis as a way for people to control their money themselves without relying on companies, banks, or governments to make transactions. Essentially, what cryptocurrency is trying to do is removing intermediaries and allowing the exchange of value between two parties. How wonderful is that? Now, this was a brief summary of the events that led to our current monetary system. Most monetary systems use fiat money to make purchases. And now I want to share some tragedies of money within our history as well. The tragedy of cowrie shells. Cowrie shells were staples in the global economy in the ancient Africa during 15th and 16th centuries. Shells were portable, small, and durable. Aside from the monetary value, it was also used as body ornamentation. Cowrie shells were viewed as symbols of wealth and fertility. Once European traders entered Africa and figured that shells were valuable within their economy, the cowrie market was doomed for debasing. Europeans started the trade kind of fairly, as they had strong interest to gain metals, spices, and textiles. Portuguese in particular promoted the use of cowries, increasing their influence in the African economy greatly. But then the exploitation began when the European countries started requiring labor to build societies in the Americas. From the 1500s to 1800s, the Portuguese, the Dutch, and British dominated the cowrie market. Europeans shipped over 12 million black slaves from Africa to America, proving that Europeans used this currency to enter the West African market and exploit Africans, degrading them to slave labor. So this was the tragedy of cowrie shells. And we also have stone money called the rye. And this was debased by one sailor. Rice stones is limestone in the shape of disc that was manufactured by inhabitants of the Yap Islands. The rye commanded value because of the perceived scarcity. Acquiring rye was hard as the discs were quarried from hundreds of miles away from the Yap Island. So the journey was very treacherous and lives were lost, even bringing the stones back to the Yap. This made them scarce and valuable. The money didn't even have to be on the island to be counted as money. So when there was a big storm and I was carrying a Yap back to carrying the rye back to Yap, and the stone ended up in the bottom of the ocean, the community was still small enough to account that the money belonged to who was bringing it. Does that make sense? I hope it does. So from 1700 to 1840, rye went from being relatively rare on the island to over 13,000 rye stones. So that's a lot. From around 140 years, they brought 13,000 stones. Rye was treated as a communal trust. The whole village was presented at the exchange, and the people used an oral ledger that the stone money changed hands. So everyone believed in it, and it was also in everyone's interest to maintain it. So for example, if I wanted to trade some bananas with, let's say, water, and I was going to use Yap stones, everybody would gather around and to make sure they recorded the transaction. So if I was trading a banana and I needed to put some more Yap, everybody would gather around and they would see that the transaction took place. And that would be kind of inside their mind. I hope that you guys can visualize it and it makes sense. The downfall of rye began from an Irish captain named David O'Keefe, who was washed ashore. The Yapese inhabitants nursed shipwrecked O'Keefe, and once O'Keefe kind of recovered, he wanted to thank their lifesavers and brought modern sailing ships and metal tools from Asia, which kind of modernized the quarrying and finishing of rye. But this invention created inflation and the system soon collapsed. The trade of rye stones kind of stopped in the beginning of 20th century due to trade disputes between Spain and German interests in the Yap Island. The Imperial Japanese forces are also cited to taking over Yap during the World War II and using stones for construction or as anchors. So these intrusions pretty much meant that quarries were abandoned. But now, they are considered a national symbol and depicted on local license plates. So it has some use cases. Although the US dollar, is their official currency, rye stones are still being used in traditional ways between the Yapese. Fiat currency. I want to take some time to dive deeper into the current fiat money we use in our current world. Fiat money comes from the Latin word for decree, order, or authorization. Here are characteristics of fiat money. Social and economic consensus. Fiat money is government issued and not backed by commodities such as gold. The system works based on people's trust of the government. The danger of fiat money is that the consensus gives central banks greater control over the economy, as they control how much money is being printed. If the government prints too much, this can result in hyperinflation. Hyperinflation is when people and businesses need more money to purchase goods due to higher prices. Hyperinflation has destroyed communities, as we've seen in Zimbabwe, Germany, Greece, and many more. The most recent hyperinflation was 2008 in Zimbabwe, where the inflation rate hit around 79 billion%. And I think hyperinflation deserves its own video because there's a lot to unpack. Represented in central bank liabilities. So this relates with accounting. We have to think about it, central bank liability, in terms of balance sheets, which aims, so the equation is assets equals liability plus equity. And what a balance sheet tries to do is to balance assets and liabilities. If a commercial bank wants cash, for example, it can ask for commercial banks loans such as government bonds. The central bank now has loans as assets and cash as a liability. But this isn't too important. And it's also accepted for taxes. Taxes make fiat money the general medium of exchange. And also, notes and coins are legal tender for all debts of public and private sector. According to the Federal Reserve, the US coins and currency are legal tender, meaning that it's a valid offer of payment for all debts. So if I create a business and sell some deli sandwiches, I have to accept your money. The government protects the value of your money, and the creditor must accept it regardless of the views toward the money. So I have to accept it because the government protects the value. But the problem with fiat money is that it's that the government can finance itself at no cost. This means that the most productive individuals and businesses have their wealth kind of robbed during inflation, as government bureaucracy have unlimited financing by having access to money printing machines. As production of fiat is the issuance of debt, everyone has a strong incentive to get into debt. This kind of explains why the government and consumers are kind of drowning in debt. So right now, I believe as of 2022, in 2021 alone, I believe we're at around $17 trillion of consumer debt, and this is very alarming. Furthermore, fiat money punishes the most productive people and savers, and also kind of rewards people who are good at politics. Money is a social construct. Money conveys the importance that people place on it. In today's digital economy, for example, digital money can design the current financial infrastructure to make it cheaper and faster to conduct monetary transactions. And here are two universal principles of money that you guys see everywhere. First one is universal convertibility. Money can be used to redeem any form of capital, such as goods and services that the economy generates. The more capital you can accumulate, the more you can provide for the future and preserve the present. For example, once the fishermen developed fishing boats and fishing rods, the fishermen didn't have to use primitive hands to catch fish. Their survival became more secure, and they were able to use their time and resources into thinking about the future. Essentially, their time preference kind of decreased to reap more benefits from the resource of time. And trust. With money as an intermediary, two people can cooperate on any project. As we discussed earlier, common currency fixes the double coincidence of wants. People don't need to trust others, but the value of money itself. But I also want to talk about the dark side within these universal principles. By design, we know that money builds on the universal trust between strangers. We don't trust a stranger we do business with, but the cash they hold. And if the cash runs out, we run out of trust. As money holds the foundation of societies, the world is in danger of becoming a heartless marketplace. And another problem of money is the bad faith actors. We live in a world where some people willingly destroy foundations that hold the movement of money and commerce. On the other hand, we have individuals who build new foundations to protect society, religion, and the environment to protect against market forces. Moving forward, we need to empower individuals to focus on autonomy and grant them the tools to navigate the world, as we have the capability to do so compared to other primates. We need to be conscious, and also we have the ability to delay gratification, so why don't we use it to make sure we create a place that we want to live in. That's the point I'm trying to get across. Okay, and I know this presentation was content heavy, and my apologies if this bored you. I sincerely hope that you learned something new and think about the systems that we live under. And I'd like to reiterate some key points from this presentation. First is that money is a tool allowing people to trade goods and services indirectly. The three main functions of money include store of value, medium of exchange, and unit of account. The characteristics of money: durable, portable, divisible, fungible, acceptable, and stable. And also, the two universal principles of money, which is convertibility and universal trust. And also, fiat money is a government-issued currency backed solely by the full faith and trust in the government, not by reserves. I hope you guys enjoyed, and we'll do a quick conclusion.